The bond market, although it's less well understood a lot of times than the stock market, is actually twice the size of the stock market. And for technical reasons, a lot of times the bond market forms sort of the plumbing of the financial system. So if you think back to March of 2020, which was probably the sharpest stock market decline of our generation, although it was really significant, the financial markets didn't seize up. They were volatile and stuff, but they didn't seize up. Relative to, if you think back to the 2007-2008 crisis, that was more bond market driven than stock market driven. And in that case, the banks and the financial system really did seize up. So the bond market's really important to the global financial system. Higher interest rates, all else being equal, are bad for bonds, but not uniformly so. And so what happens a lot of times is if inflation gets higher, bond prices get higher, but not all bonds are created equal. And we've got a slide that takes a look kind of under the hood at those things. And so there's a lot of numbers on this slide, but as we look at it, if you look at the right-hand column, the rightmost column, that shows the correlation of the S&P 500. And so that's how closely does this bond move with the S&P. 1.0 would mean that it moves lockstep. If the S&P moves up 1%, the bond moves up 1%. Negative 1% would mean that it would move exactly opposite. And what you can see is the numbers in red are negative correlation. So that's where you get diversification. So you can see at the top here with a number of different treasuries, they move the opposite of stocks a lot of the times. Not all the time, but a lot of the times, providing that diversification. And then as you look down below, the second half of that chart below the line are more somewhat riskier types of bonds. And so you've got investment grade corporate bonds. You can see convertible bonds on there. USHY, that means high yield bonds. Municipal bonds and whatnot. You can see that most of those are somewhat correlated with the S&P 500. They're positive numbers, but it's not 1%. And so that means that although they move directionally sometimes with stocks, they don't move in lockstep. And so you still get some diversification benefit. The other part there is the correlation to the 10-year. That's the second column from the right. And that's really showing how closely do these types of bonds move to the 10-year treasury. You can see the fourth line from the top, the 10-year treasury is 1.0, right? Because it's measuring it against itself. Everything else moves somewhat less or more. And so importantly, if you look down at the bottom half of that, you can see that a lot of these bonds are not perfectly correlated to the 10-year treasury. So corporate bonds have a 0.42 correlation. You can see that high yield bonds are actually negative. That means that they tend to move inversely to the 10-year treasury. And so the point here isn't to become an expert on the nuances of each sector of the bond market. It's to understand that when we talk about the bond market, there's really no such thing. What you have is a market of bonds. And that little twist of phrase is meant to point out that every bond is different. There are millions or hundreds of thousands of bonds out there. And as you look around, you can choose bonds that if you put them together, don't move directly with interest rates, maybe don't move directly with stocks. You're really trying to build that portfolio that complements your existing holdings. But at the same time, what you don't want to do is get overly aggressive in your bonds. You want to remember that for most of you out there, your bonds are probably your safe money. They're there to support if you have an emergency cash flow need or if you're trying to distribute income from the portfolio over the next several years. A lot of times, that's what the bonds are there for. And then the stocks or real estate are there for longer term growth.
Are you prepared for retirement? Schedule a free financial assessment with an experienced financial professional right online at purefinancial.com.